Bitcoin has recovered slightly, but will we be facing a short squeeze? What has caused this rise? How's the macroeconomic data affecting cryptocurrencies? Why is the dollar gaining so much strength? What's the most relevant data in the US? What about the Eurozone? We're going to tell you everything here in our Mundo Crypto analysis. In the weekly time frame, we can see that this week, starting July 4th, a significant bullish movement was carried out after crossing the RSI's oversold zones that hadn't been reached before. Over the last week, we can see a change in the RSI's direction. The current weekly engulfing candlestick displays a pretty important upward movement, which has gone on to test the important resistance in which the price currently sits. When displaying the moving averages in the weekly time frame, we can see that the price has gone on to test the 200 period moving average, converging with the resistance zone at $22,700 approximately. But we must pay attention to the volume, which, as we can see, hasn't been as significant in this week's movement. So we'll have to wait and see how the week closes. In the daily time frame, we can see that the price headed towards the downside, which later headed towards a bottom at the beginning of July, within an important support zone at roughly $18,800. The price gravitated towards those liquidity orders mentioned in our previous analysis. As we can see, when approaching that inferior part, a dragonfly candlestick started to form on June 30th, while a classic doji candlestick formed on July 2nd and 3rd, displaying indecision and weakness in the bearish movement. If we take a look at the RSI, we can see how it almost formed a divergence, and in the wave trend, in the oscillator compound, that divergence took place from May 13th to July 4th. This reveals that the price is stuck within a range of $22,700 to $17,500, so we'll have to wait and see whether this turns out to be a cumulative or a distributive pattern. When looking at the averages in the daily time frame, we can see the importance of this movement. Once those divergences mentioned earlier formed, we can see that towards the beginning of the week, due to the impact of other markets, on-chain movements, and certain fundamental factors which we'll be looking into later on, we could say that the reversal pattern is starting to form. A rising star pattern tends to be made up of 3 candlesticks, although in this case there are 4. The order of the pattern tends to be the following: bearish candlestick, doji candlestick, and a full-bodied candlestick with significant volume input. This sign, added to the divergence mentioned earlier, led to a bullish movement. On July 5th, pretty important macroeconomic data was published, which caused that indecision, while the 20-period moving average acted as a resistance. However, from that moment on the 6th, a day on which other important data was revealed, it managed to close above the 20-period moving average. On July 7th, it evidently managed to surpass that average with volume input, leading to a continuation following certain liquidations. The price headed towards that important zone at approximately $22,000. In today's candlestick, we'll see whether it ends up turning into an inverted hammer candlestick or a shooting star candlestick, as they have very different connotations. In order to see a continuation move towards the upside, we'd have to head towards the macro range of $22,700 to $17,500. As seen through the date marked in white, there would have to be a breakout consolidation in order to head towards the resistance at $24,500, which converges with the 50-period moving average in the daily time frame. On the other hand, if we end up seeing a shooting star candlestick, or we're unable to close above the resistance, we could be facing a short squeeze. But what is a short squeeze? It is a quick increase of an asset's price, mainly due to the market's technical factors rather than underlying fundamentals. This is why we must pay attention to that possible sprint deriving from a distributive moment. If we're unable to overcome the current resistance zone, or we see a movement similar to the one we've marked in white, the price could once again head towards the previous support. And here's one of the reasons behind Bitcoin's boost. Following the SP500's bearish movement and the 20-period moving average acting as a resistance, we can see that on July 1st, another movement with volume input was carried out, which retested that average until July 5th. On that day, we can see great volatility as a consequence of the macro news developments, which we'll be discussing shortly, but rejected the bottom of the minor uptrend line. On July 6th, the Fed's minutes were published, which offered slight assurance but wasn't the most positive outcome. This affected the SP 500. On July 6th and 7th, candlesticks closed above the 20-period moving average. The candlestick on July 7th is a full-bodied bullish candlestick that was able to make its way to the resistance at 3,850 points, although its volume dropped as with Bitcoin. A bullish scenario would require the SP 500 to remain in the 3,850 point zone. If a pullback took place, we could see the index touching 3,950 points, where there's a pretty relevant zone that converges with the main trend line and the 50-period moving average. If we see that the index loses the minor trend's uptrend and the support zone, in which the 20-period moving average also sits at roughly 3,800 points, we would see a continuation towards 3,700 points. And in the dollar index, we can see that in June, it managed to break the 104 points and consolidated, forming a parallel channel above the resistance zone and using the 104-point zone as support. On July 1st, we can see that the dollar started testing the superior part of the range, and once again on July 5th, it gained strength as a result of fundamental factors surrounding the Eurozone, which we'll be discussing later on. In the relative strength index, we can see how it crossed the 70-point zone and nullified the divergence that was forming between May 12th and June 14th. This could result in a bullish continuation towards 109 points, but a new divergence could form. If the dollar runs out of strength, it could go on to test the 105-point zone or even that of 104 points, where the uptrend is found. The Federal Open Market Committee minutes are a detailed record of the committee's policy meeting held about 2 weeks earlier. The minutes provide detailed information about the FOMC's stance on monetary policy, which is why currency traders scrutinize them in search of clues regarding future interest rate decisions. The recently published minutes reveal that directors of the Central Bank of the United States have a clear priority to reduce inflation with rate hikes, even if this means a slowdown in the economy. The Fed believes it is crucial to maintain the credibility of the central banks to control prices, which points to another rise of 75 basis points at the end of the month. According to them, tightening the monetary policy is necessary to reduce inflation to 2% and achieve high levels of employment on a sustained basis. ISM Services PMI displays the level of non-manufacturing activity carried out over the previous month in the United States. Any reading above 50 indicates expansion, while any reading below 50 indicates contraction. The June non-manufacturing PMI was lower than that of May, but still totaled 55.3 points, while the business activity and new orders sub-indices were also relatively positive. But as a quick reminder, this sector, the service sector, has much less of an effect on the GDP than the manufacturing index. Initial unemployment claims measure the number of people who have applied for unemployment insurance for the first time during the past week. This is the first economic data from the US, but the impact of the market varies week to week. The data has been a little worse than expected, sitting at 235,000. More people applying for unemployment could be a confirmation of an economic contraction and could perhaps encourage the Fed to rethink its position, although this seems unlikely if we consider the minutes. The unemployment claims data is a weekly and volatile data, so it will need to be confirmed through the unemployment rate data, which is a lot more precise. And the non-farm payroll data measures the change in the number of people employed over the past month, excluding the agricultural industry. Job creation is the main indicator of consumer spending, which accounts for the bulk of economic activity. Let's bear in mind that this is the most widespread data on job creation, which has a direct impact on consumer spending and therefore on inflation and GDP. If it is a negative figure, it could be a sign of economic contraction. If, on the other hand, it exceeds expectations, the Fed's aggressive stance on interest rates could continue. The unemployment rate measures the percentage of the total labour force that is unemployed and has been actively looking to work for the past month. Considering most of the employment is produced by non-farm payrolls mentioned earlier, if unemployment data worsens, it could be a confirmation of an economic contraction. This could keep the Fed on check regarding a recessionary scenario. On the flip side, if employment continues, it would give the Fed more room to continue with its aggressive or hawkish approach, as it would back its views on full employment. The euro's fall has been caused by the rise in the CPI. In other words, inflation. Additionally, the ECB is being less aggressive than the Fed regarding raising interest rates. The recessive factor is more and more present in the Eurozone. Moreover, energy supply chain factor affects it much more in regards to Russia, given we are more tied to oil and gas. Therefore, this is a cycle that causes the ECB to adopt a less aggressive approach surrounding interest rates. The risk around potential gas supply cuts in Russia is pushing the European Central Bank to slow down its interest rates rises out of fear that it could trigger a recession. And now let's analyze the Producer Price Index, which measures the average change in prices experienced by producers when selling their products. It is the leading indicator of consumer price inflation, accounting for most of the inflation. Usually an increase in the PPI will, in the short term, lead to an increase in the CPI, and therefore an increase in interest rates and the currency. During a recession, producers cannot pass on their increased costs of the material to the consumer, so an increase in the PPI will not be passed on to the consumer, but will reduce the producer's profitability and deepen the recession, which can lead to a currency decline. A better than expected figure has been achieved, 36.3% compared to the expected figure of 36.7%. However, this figure is still much higher than the previous year, which is not assuring at all, causing the euro to depreciate. Retail sales measure the change in the total value of inflation-adjusted sales at the retail level. It is the leading indicator of consumer spending, which accounts for the bulk of overall economic activity. And although this data is again a little bit better than expected, placing it at 0.2% compared to the forecast of -0.4%, it is still a very worrying figure that reflects the economic contraction and a consecutively devaluation of the euro. And we must pay attention to the head of the ECB, Christine Lagarde, who holds a position that the institution will follow regarding short-term interest rates, which could greatly influence the value of the euro. Investors always watch their speeches closely, as they often hint at future monetary policies and changes in interest rates. Their statements could cause a short-term positive or negative trend. And now that we've covered the most relevant macroeconomic factors, let's carry out an on-chain analysis. As we can see in the Fear and Greed Index, fear has dropped slightly, possibly due to the news surrounding Celsius, who managed to pay off their loan on MakerDAO. However, we're still in a state of extreme fear. In the balance of exchange reserves, we can see their continuous reduction, reaching lows unseen since August 2018. Back then, the balance headed to the upside. In March 2020, that trend changed, after which investors do not seem comfortable with storing their bitcoins on exchanges and would rather hold them in long-term cold wallets. This doesn't seem to change despite the panic in the markets and bearish situation. However, this hasn't yet affected its price. Exchange net position change, or net flow, is an indicator that measures the net amount of bitcoins entering or leaving wallets of all exchanges. When the value of the indicator turns negative, it implies that a net number of tokens are leaving exchange wallets, as the outflow dominates the inflow. As we can see, the trend is outgoing and remains in line with what is shown in the reduction of balances in exchanges. But as mentioned, although this is a positive sign, it has not yet had an impact on the price, and true holders seem to be doing their job well. But new players, speculators, certain funds and miners, which we'll be discussing shortly, do not follow. The distributive phases prevail at the moment, given supply continues to exceed demand. Here we can see how the capitulation of miners continues, as mentioned in our previous analysis, and this, added to the reduction of certain funds, has had a negative impact on the price, redistributing said holdings, leading to a new price construction. As we can see, since June 19th, their balances have fallen drastically, and from then on until July 6th, where we can see a small increase in reserves, the capitulation has encouraged Bitcoin's price rebound. However, this is not yet relevant and does not yet indicate where the miner sales will come to an end. And here we can see the relevance of the $19,000 zone, with the greatest buying and selling interest in Bitcoin serving as a pivot zone, as we saw in the technical analysis. If this zone were to be lost, we could be facing a redistribution, leading to the $16,400 area, where the next relevant area is found. Realized price per address displays the average price at which all current unspent Bitcoins have been purchased based on the size of the wallets. Here we can see that this latest price rebound has headed towards the realized price zone of portfolios between 1,000 and 10,000 Bitcoins. If this movement does not consolidate, it could be a mere pullback heading towards the $13,000 zone, which is the realized price of wallets between 10 and 100 Bitcoin, which would first pass the $16,000 zone as discussed just now. This realized price zone of wallets between 10 and 100 Bitcoins has statistically coincided with the market bottoms. However, let's not forget that these are just statistics and not certainties. And something worth noting is that at the end of June, we can see that the funding rate was negative, meaning shorts paid longs. This was incentive to go long, as there were plenty of leverage positions as seen in a high funding rate. From that moment on, we can see a change, and on July 2nd, 3rd and 4th, it turned into a positive funding rate where longs were leveraged in greater quantity, surpassing shorts, although strength has reduced in recent days. This is quite relevant as it could cause a cascade of futures liquidations. This heat map reveals how the price headed towards that inferior part with a relevant liquidity cluster at the end of June and absorbed the buy orders, which pushed the price to the upside. As we can see, it managed to absorb all those subsequent sell orders of approximately $20,000 without turning back. At this moment, it approached the $22,400 zone, where the most important short-term cluster sat, and these sales were absorbed, leading to a price rejection. In this other heat map, we can observe something similar. At the end of June, there were plenty of buy orders between $15,000 and $18,400. The ones at the top have been absorbed. And in this chart, we can see the number of liquidations that occurred in recent days. The cumulative delta volume experienced an increase, futures marked in blue and spots marked in green, serving as a sign that buying was beginning to prevail. At the end of June and beginning of July, a multitude of long positions were liquidated, enabling the repositioning of longs and changes in the funding rate. From that moment on, short liquidations began as the price rose and the leverage rate rose. Now we'll have to wait and see whether the price could result in an inverted hammer candlestick and head towards the upside, or on the contrary form a dragonfly doji or shooting star candlestick with a bearish movement, and whether it is a short squeeze or not. In this chart, we can get a better view of those liquidations mentioned earlier. At the beginning of July, we can see that those positions were liquidated and short settlements were rewarded. In short, despite the rise in Bitcoin, the macroeconomic picture is not at all positive, and the Fed seems to maintain its aggressive stance against inflation, even if it results in a recession. Meanwhile, in Europe, inflation data is quite alarming, and supply chain issues could stall economic growth. The lukewarm stance on interest rates is also substantially devaluing the euro against the dollar. Blockchain data, on the other hand, is positive, at least for the medium term, but we'll have to be very vigilant in the short term, as we could be facing a short squeeze.